The integration of environmental, social, and governance (ESG) factors into corporate strategies has transformed how businesses operate. From supply chain restructuring to innovation in green technologies, companies are increasingly expected to align their business practices with ESG goals. As this transformation unfolds, it brings with it significant tax and transfer pricing implications, particularly as tax authorities, stakeholders, and the public demand more transparency around sustainability efforts. This video will explore how ESG intersects with TP and the steps businesses must take to ensure compliance while supporting their sustainability initiatives. ESG has gained momentum as a key driver of corporate decision-making. Companies are under pressure from regulators, investors, and consumers to minimize their environmental impact, improve governance, and demonstrate social responsibility. ESG initiatives influence a wide range of business activities, from energy-efficient production processes to ethical labor practices across global supply chains. These initiatives also require companies to evaluate how ESG goals affect their tax policies, including TP arrangements. ESG is no longer a peripheral concern. It is now at the core of business models. Companies must embed ESG principles into their operations to manage risks, enhance their reputation, and meet regulatory demands. However, the changes ESG brings can result in shifts to a company's functional profile and supply chain, which in turn impact TP arrangements. One of the most significant areas where ESG influences TP is in the reorganization of supply chains. As companies strive to reduce their environmental footprint, they may move production facilities closer to markets or shift to greener manufacturing technologies. These changes often result in adjustments to the allocation of profits among different jurisdictions, leading to potential tax challenges such as exit taxes and increased scrutiny from tax authorities. For example, shifting production to a lower emission facility in another country can trigger business restructuring rules under the OECD TP guidelines. This can lead to the revaluation of assets and profits in the jurisdiction of the former location, potentially attracting tax liabilities. Moreover, regulatory frameworks like the EU's Carbon Border Adjustment Mechanism, CBAM, further complicate the landscape by imposing taxes on carbon-intensive imports, directly affecting TP policies. ESG initiatives often lead to the development of new intangibles, such as intellectual property, IP, related to environmental technologies. These green intangibles may include innovations in energy conservation, waste reduction, or sustainable packaging, which are critical for companies aiming to meet their ESG goals. Valuing these intangibles within a TP framework is complex, as it requires accurately identifying the parties responsible for their development, maintenance, protection, and exploitation (DEMPE) functions. The valuation of these intangibles should reflect the contribution of different entities within the multinational group to ensure that profits are allocated appropriately. Failing to do so could result in TP disputes, as tax authorities may question whether the entities benefiting from these intangibles are being rewarded in line with the value they create. With growing expectations around corporate accountability, ESG is driving demands for increased tax transparency. Stakeholders, including investors and regulators, are calling for clearer reporting on how businesses pay taxes in different jurisdictions, particularly as it relates to profits generated from ESG-driven activities. The Global Reporting Initiative, GRI, 207 on tax, for instance, requires companies to disclose information about their tax governance, risk management, and tax payments on a country-by-country basis. TP policies must adapt to these demands by ensuring that they support the company's broader ESG objectives. For example, a company that prides itself on sustainability must ensure that its TP arrangements are not perceived as aggressive or aimed at minimizing taxes in low-tax jurisdictions. Aligning TP with ESG can help protect the company's reputation and reduce the risk of regulatory penalties. It is essential that TP policies are revised to reflect the company's ESG commitments. This might involve revisiting existing cost allocation arrangements, royalty agreements, or profit-splitting mechanisms to ensure that they account for the contributions of entities involved in ESG-related activities. A robust TP framework will ensure that these contributions are adequately rewarded, avoiding potential disputes with tax authorities. As ESG initiatives drive changes to business operations, it is critical to update TP documentation to reflect these developments. This might include changes to the company's supply chain, the introduction of new green products or processes, or the relocation of key functions. Timely updates to documentation help ensure compliance with local tax laws and reduce the risk of penalties during tax audits. As regulatory requirements around ESG and TP become more complex, companies are increasingly turning to digital tools to streamline compliance. These tools can help track emissions, monitor ESG-related KPIs, and integrate this data into TP models. Automating the collection and reporting of this information reduces the risk of human error and ensures that companies are prepared for audits. By adopting best practices and proactively engaging with tax authorities, companies can navigate the complex relationship between ESG and TP, ensuring compliance with global tax standards while supporting their broader sustainability objectives. As ESG continues to shape the global business landscape, its impact on TP will only grow, making it critical for companies to stay ahead of these developments.